And Nancy, the dollar's stronger, stocks are selling off, everybody's worried about higher rates for longer, the message from the Fed, that was the message from the ECB, and yet bonds are getting bought right now and yields are slipping. So what do you make of the sell-off, and what do you do?
Well, this is one time where I'm going to basically pound the table and say you go in and you buy now. The Fed is almost done. The bond market is telling us that they're almost done and that we should expect economic slowdown. So it's important to buy the right kinds of stocks. But this volatility, the market movements today have been very typical of every post-meeting press conference. The market is reading the same data, and they're saying, listen, the economy is already slowing, and we have multiple examples of that. Shipping rates, new orders, inventories rising. You could M2 flat. You could go on, and there's plenty of indications. PMIs rolling over that inflation is on the move down. I think. Investors should be looking at the same thing the Fed is looking, and that's a 3-month annualized rate. You now have estimated inflation below the Fed funds rate. And so I think we're closer to the end of this, and this is a good time to be going in and buying high-quality names that are reliable growers. And I brought one for you today.
Yes, tell us.
Okay. Xylem. This is a company that is a water treatment and solutions company. Has been hurt by a tremendous backlog. Well, the supply chain is now easing. They embrace our theme, which is old economy companies that are embracing the digital revolution. They saw growth in Europe despite the European economy, and they pay about a 1% yield, and they grow the dividend 10%. And the last thing that is important about this company is it's an ESG darling, which puts kind of a floor under the stock price. So this is one on any weakness you step in and you just incrementally add to holdings, and it will continue to perform in slow growth environments and high growth environments.
It's down about 7% or so in the last 12 months, so outperforming the market, really outperforming in the last 3 months. Charlie, do you disagree with Nancy's premise that the Fed should be closer to the end and you should be buying stocks?
Should be. Absolutely. I agree. That's the whole frustration here, is that the market is looking at the data and saying the Fed should be close to the end. But I just don't think you could listen to that speech yesterday and believe that that's where Chairman Powell is, let alone the rest of the people. These are people that are insisting. Yeah.
No, I just want to pick up on that point. So, Nancy, are you saying to fight the Fed? I thought you're not supposed to fight the Fed.
The Fed's been behind all the way through, and the bond market and the stock market have led, and they are going to lead them out of this. And if you go back and look at the dot plot in September of 2021, they didn't even get to 2% until 2024, and that wasn't even a majority of the Fed governors. So we on Wall Street, we put so much emphasis on every short-term piece of data and metric, and that's the overreaction that you're seeing. But if you look forward, which you should do as an investor, they are not going to have any choice. The market's already making that choice for them in many instances, and we are seeing economic slowdown. I mean, GDP now just got revised down again today to the mid-2s for GDP growth in the fourth quarter.
Retail sales,
so we're seeing it, and it's also a great time to be buying stocks because stocks bottomed a couple of months before Volcker changed his tune in 1982, and they erased all of the market sell-off or bear market in 3 months. Now, I'm not saying that's going to happen now, but I am saying by the end of next year, you're going to be happy if you went in and added to high quality names. Our theme is old economy companies embracing the digital revolution, and then the companies that provide those digital solutions in a low productivity, seriously limited participation rate from a labor standpoint. You need to own the solutions to that, and that's technology, and then the companies that are benefiting from embracing digital.
Sorry, Charlie, didn't mean to cut you off. How does that fit into your worldview here of the market?
Sure. If you're willing to look longer term, then 100% agree, because there are very good quality companies that are going to do very well on the other side of this recession. But between now and then, it is going to be painful. So you better, if you're going to take the strategy, which I am taking, of investing long term, you better be ready for volatility in the short term. And the only thing I want to push back on a little bit is a lot of us were telling the Fed that they needed to be more serious about inflation way before the Fed got serious. And I think this is going to be the same playbook. A lot of us are going to be telling the Fed that the inflation situation is in better shape, and they're going to be slow to react. The Fed is always slow. The Fed is always behind. The data is always behind. and they are making it clear that they are behind. And so I think we're going to have this tough Fed until the middle of next year.